If you're not trading macro, you're not trading anything. Most traders have no idea why the market moves. They see charts, patterns, indicators, and they think that's analysis, but it's not. That is surface level. Because if you really understand macro, you're not actually trading the market, you're just reacting to it. Every asset, equities, bonds, FX, commodities, it's all driven by underlying forces, policy, credit conditions, and capital flows. When policy shifts, when rates move, when growth expectations change, everything reprices. That is macro. That is the foundation of this market. I trade solely on macroeconomics and market structure. I don't need a moving average telling me what's happening. I already know why something is happening. Because when policy shifts, when positioning adjusts, when expectations change, the market has to respond. That's not prediction. That's understanding how the system functions. Why does the stock market rally on weak data? Why do bond yields fall months before a recession is confirmed? Why does the dollar strengthen when global risk appetite collapses? These are not random moves. They are cause and effect, a direct reflection of how capital responds to macro change. Once you see that, every move in the market starts to make sense. The truth is, if you're not incorporating macro into your strategy, you're just trading blind. You're reacting to price without knowing the reason behind it. And if you don't know the reason, you can't know the durability of the move. You can't tell when it's exhausted or when it's just the beginning. If I drop to a 5-minute chart and draw a bunch of lines on the screen right now, none of these will make any sense. You cannot tell me that the market is moving because I drew a couple lines, a Fibonacci retracement tool. This makes no sense. The market is not moving because we had a liquidity sweep here. We respected this Fibonacci tool. We had a sweep of the lows. I'm setting an indicator here that makes no sense. This is why understanding the market is so key, because without context, these lines and tools mean absolutely nothing. To take a trade like this, you don't need to predict headlines. You need to understand the structure that drives them. Policy, credit growth, inflation, positioning. That's the real market. Everything else you see on a chart is honestly just noise. Every serious institution, every hedge fund, every central bank, they all trade based on macro. Retail traders ignore this and wonder why they can't stay consistent. So if you want to be a profitable trader, stop chasing price, start understanding the system that creates it. Because without macro, you're not trading reality, you're just trading noise. And to me, macro is not an edge. Macro is the entirety of the market. So I wanted to look at CPI that came out from today, October 24th. Here's the data. Core CPI month on month came in at an actual 0.2 with a forecast of 0.3. CPI month on month came in at 0.3 with a forecast of 0.4. CPI year over year came in at 0.3 with a forecast of 3.1. So across the board, inflation came in a bit softer than what we were expecting. And these numbers might not sound like much, just a small miss, but in macro, that is a big deal. Softer inflation tells us prices are still cooling down, which means the Fed doesn't have as much pressure to hike rates again. And when this happens, the market relaxes, rates ease off, the dollar loses some strength, and assets like gold start to benefit. As you can see on a lower time frame, you can see how gold ripped today just from CPI. So in simple logic, when interest rates start climbing, holding gold becomes more appealing. Gold doesn't pay interest, so when rates drop or level off, gold gets more attention. And that's when the dollar cools. That's another tailwind for gold. So now, obviously, I'm looking for more gold longs. So for me, I had this great gold short. I already made a breakdown on this trade. We could have held this for so much longer. As you can see, we came back and retested all-time highs and had that fall off again. My direction was correct. My entry was perfect. And overall, that was just a great trade. And I haven't taken another one in 2 weeks because I've been waiting for the market to cool off and show me where I should be positioning myself. So now with the data from CPI showing me that we can start looking for more longs in this case, with the current state of inflation, this is when I will start looking for more market structure. We have these highs here, and we have these lows here. Obviously, this is a huge wick to the left that I'm not exactly super interested in pricing in at the moment. But right now, what I want to start seeing is a break of these highs. I'm going to want to see more market structure. I'm going to want to see a retest of this area, and then some sort of situation like this back to all-time highs. So for me, there is no perfect entry model. It is very much based around all the market structure that we see on our charts. And like I always say, market structure only takes up around 20% of my overall strategy, because really all I'm looking for is higher highs and higher lows and positioning myself accordingly. Obviously, going into the end of the year as well, we should take that into account, with Q4 being historically the best time for the stock market, and then understanding how this will affect gold as well. So for me, I do see a level right here that I would like to see visited. And I would be very interested to see if we can, crush these all-time highs before the end of the year. But honestly, only time will tell in this situation. And me personally, I am just sitting back, waiting for this market structure to form and give me the right opportunity to enter into a trade. And for me, the story here is simple. Inflation is easing, the Fed can back off, and that supports gold. And this is what it's like to trade macro. You're not just reacting to a spike on a chart. You're connecting the dots between the data, policy, and the market's reaction to this. And that's the whole game, understanding why something is moving, not just that it's moving. So if you're not paying attention to macro data, CPI, jobs, the Fed, you're basically just trading blind. And when you do, suddenly everything starts to make sense. You see the story, not just the candles. That's trading with purpose. And that's what separates a real trader from someone that's just pressing a few buttons. Macro isn't some secret weapon, it's just the truth of how the markets move and why the markets move in that direction. Whether you're a swing trader or a day trader, I definitely think you should be understanding macro and incorporating that into your strategy, because you're no longer guessing which way the market is moving. You're understanding why it's moving in a direction and how you can profit off that information. This is all public, free information that you can use to benefit yourself and your trading in the long run. If you guys enjoyed this video, make sure to leave a thumbs up, subscribe. I'm going to be making more videos like this in the future, and I'd love to have you guys learn something new and something that could help your trading in the long run.